You there, Peter? Unmute. Here, maybe I have to ask you to unmute.
Can you hear me?
Got you, buddy. Got you.
Good.
Welcome back, Peter. How are you?
I'm good.
So, why don't you tell us about how you got caught in a lockdown in Europe and how and how you escaped Europe? You know, the Great Escape. Welcome back to safety, and a good time to have you here. If you want to share your screen,
I'm going to do that.
Are you implying, Dale, that Europe is unsafe for some reason?
No, but he just wanted to get home and he couldn't because of lockdowns in Europe.
No,
just 1 second. I'm bringing up my.
You didn't say nice to be back safely. You said nice to be back on safety. That's why I asked.
Oh, yeah, I don't know. I wouldn't want to be locked up here, there, anywhere.
No,
so
with that, I can't disagree at all.
Yeah, so good to be at least have the illusion of freedom like we do today. So I prefer the illusion. I'm into denial very big. So Peter.
I'm just loading my charts here to discuss with you guys. And
I remember when we were talking about time cycles or when a peak might occur in the market. I believe you didn't think, I kept talking about a lot of key guys I talked to that are, into measuring time and cycles were pointing towards April. I think at that time you didn't think it would hold together as long, but you were absolutely dead on about that we would see around 4,000. And, one of your associates who lives in Maui, his name again? Was on with me, or he works with you, or
Ed Dowd?
Huh? Yeah, Ed.
Dowd?
And Ed said, when we were breaking back down towards 3,800, I was thinking about you and the call you made, and Ed kind of probably was sharing your thoughts. As long as we held 3,700, it was going to be a correction and a move to new highs. So here we are. I've set it all up for you, buddy.
Now, are you seeing my screen? Seeing or my charts at least?
Yeah, we see the S&P with some bands. And
these are the earnings, just to start it off with.
Okay.
Something that entirely doesn't matter, which is earnings.
Okay, right.
As you can see, my situation is if you hear anything in the background, if you hear birds in the background and stuff like that, I'm at my office on the beach. And if you hear the ocean, you might be able to hear that too. But
where are you?
I'm in Boca Raton area on the beach right now. So I'm literally
nice
on the beach.
Nice. Yeah, you're on you're kind of like
basically
you're a nomad, aren't you? Are you one of those nomads? You just travel around?
No, I'm not a nomad. It's just home. So.
Oh, this is home. Okay, all right.
Yeah.
Nice. Okay, Boca.
But basically, I'll just touch on the lockdown in Europe. I think the situation in Europe is a horror show. I've never seen a more manipulated agenda than what they're doing there in terms of fabricating. They'll test people 5 times for this and that and whatever.
Yeah. All right. Well, I'm just glad you're back. There's I know that you have a strong opinion about the whole pandemic. I do, but I'd rather keep it to the markets, buddy. And
I agree.
Because it's almost why? It's a shame. It's political. All right. Public health has become political. Anyway, so let's talk S&Ps here.
Yeah. So basically, let's look at the at this situation where we are right now. We have essentially the earnings history for the S&P over a very long period of time. And as you can see, there has never been a bigger disconnect between earnings and the actual valuation of
the market. I lost your audio.
all the different, things, above them in a bigger way than every market, including 1929. So recently we had something else happen, which is rather interesting, which is that the Nikkei, and I believe
You're fading in and out, Peter. Yeah, Peter, we're having audio issues here.
Okay, can you hear me now?
Yeah, it fades in and out. It sounds like
Yeah,
I know you.
It should be good. It should be good now.
Okay, because it sounded like you were snorkeling, and I know you're near the water, so. Okay.
Yeah, but I'm not snorkeling.
Okay, go ahead.
Anyway, so where we are here is that I believe we discussed this chart last time. We're dealing with the Nikkei breaking out earlier, and it actually looks like the Nikkei wants to do a double top to me. It's broken out several resistances. It might fail earlier, and I want to discuss that because I do think the markets are on a short rope here, but I think that they have more upside than people might imagine because the
Sentiment.
Because the recent highs have been confirmed. So we have confirmed highs and a combination of much more negative sentiment than people actually believe.
Confirmed by what, Peter? By momentum, by advanced decline? What was it that confirmed this last high?
The confirmed, when I talk about confirmed, I'm talking about emotionally confirmed highs. Because to me, how in my process, how trading works is that fundamentals don't matter, put calls don't matter, VIX doesn't matter. All these things don't matter. What matters is they all have their contribution, but they don't actually drive reliable analysis. What drives reliable analysis is the emotions of people, and if those emotions happen to be connected to price. So if you have a very emotional market and it's successfully driving price, then that's a confirmed high. So you have to be able to measure the emotions, and you have to then be able to say, okay, are the emotions matching the prices? And if they are, then you know that you're not going to finish when emotions match prices. You finish when emotions don't match prices. You have inflection points and dissonances in markets when things are disagreeing, not when they're agreeing. And whether people like it or not, and I'm a bear, so I don't like to see markets, showing that chart that I just showed you before. I think that's a very unhealthy situation. But the reality is emotions are what is carrying price forward. And emotions aren't just people's emotions. They're emotions of central bankers, central planners, bankers, investors, institutions, and analysts. So, and then retail people and options players and market makers. All these emotions are all driving prices. So,
so prices and emotions are bullish right now because emotions are positive.
Well, because the recent highs were confirmed. So the highs, I had thought that it was possible that in February or March, we would see unconfirmed highs. It became very clear in January that it was not possible to see adequately unconfirmed highs, emotionally disconnected highs in February. And it was going to have to be maybe March. And now it's absolutely not going to be March because it's over, April Fool's. So I believe that we're coming into a period basically in the next 3 to 6 weeks in which the markets are going to start to change their behavior in a significant way, especially because I'm starting to see people now extrapolating their views out further and further and further. And this is generally something that I look at anecdotally and say, okay, when lots of people decide they're going to look forward and start carrying very, very extreme beliefs, years and months into the future, we're usually running into some issues with reality deciding to fix that. Now, the reason I'm sort of mentioning that is because we're going to come into a cycle soon where the highs are not confirmed. And when that happens, I think we're going to be dealing with some serious consequences. Now,
how will you know that they're not confirmed? What will the emotional?
Well, I'm going to show a chart that will show that. But I have a number of emotional metrics that I use that help me to determine this. And, I want to just be clear. I'm expecting that April or end of April, early May, we would be creating an emotionally unconfirmed price highs. Now, if we were to create confirmed price highs, I'm going to be continuing to have the same scenario. It just means that the market's going to keep going higher. And I want to emphasize that, we are in what I believe is an extended wave. And these extended waves, you cannot predict a top on them unless you have emotional non-confirmation, in my opinion. And even then, it's not the easiest thing to precisely nail the top, because you need to, navigate something where the market can move plus or minus a few percent even after that. So, but basically, the way that this is looking to me is that we should see unconfirmed highs sometime, good quality, fully unconfirmed highs sometime this month or early next month. But it's also possible that can extend into June or July. I don't see how it can go past July, just to be completely frank with you. So I believe we're dealing with a situation which is going to reach an untenable level sometime in the next, I think, 3 to 6 weeks and maximum 2.5 months. And I would say I don't put the odds at 2.5 months that high, but central bankers and central planners are having a field day right now, so you don't want to.
You have any upside targets that you're looking for?
Yeah, I'm going to show you. Basically, what we're dealing with on this chart right now is showing several indexes. We're showing the S&P, the transports, and the Dow. And as you can see, the Dow has cleanly broken out over broadening pattern high. And when these things happen, they just don't stop. They just don't say, oh yeah, it's an overthrow, we're just going to reverse right now, especially when the S&P has done it in this way. So the S&P has made extremely clean breakout over this broadening pattern. And to me, that is either incredibly bullish.
Yeah, a couple of successful retests of the throw over.
Yeah, so either this is incredibly bullish and it's going to go on forever and indicate a new bull market lasting for 12 years or something like that, or 5 years or whatever, or it's a part of a larger throw over. My belief is that we're in a part of a larger throw over, but I'm open to that. I take it one step at a time. I might have an idea
how about this for one step, Peter? Closing back inside of the broadening top.
Yep. Closing back inside this broadening pattern would be deadly right now.
Okay. It looks like about
so
3,800.
It's important that people take a look at this 3,800 area, 3,820 area presently, which is, rising pretty fast. And below 3,850, the market's in very deep trouble.
Okay, cool.
And this is an important chart because this is a very long look at the Dow. And as you can see, this red line has been a key trend line. Now, one of the things that happens when you get into declining quality rallies is you don't actually get to the top of a trend line, you get close to it. Believe it or not, I think it's possible for this blow off to take the Dow up another few thousand points, possibly even more, maybe 10,000 points. And that would then create an adequate failure potential at this red line. You can also see a large broadening pattern here on the Dow that bottomed in 2020 and that we have bounced off of. So these are, not inconsequential patterns. And something to keep in mind that in a running extended wave, we can go further than you think, even if it doesn't make any sense at all. Okay.
Yeah. The rubber band.
Yeah. This is what I'm looking for, but I'm not married to. I want to be clear. Okay. What I believe is that we are looking at something in April where we make quality unconfirmed highs. So you can see that here.
Yeah.
And those would be likely to be coming with a throw over on this pattern, since markets need something emotional. The targets on this roughly are about 41.60. If you've been following me, you know that my minimum target was 40.30. But I felt like that the target area was probably between 40.30 and 41.60. And so if you put 41.60, handicap it and say 4,100 right in the middle there, then plus or minus 200 or 300 points from there seems to be not 200 or 300 points, but say 200 points. We could extend over that by 200 points pretty easily. So I think, 4,300 is possible. I don't actually think we get there. I think it's more like this, but you never know. But it looks to me like we're dealing with something, in April, OPEX is probably a very good time, April OPEX, to look at the market, putting in some pretty unhealthy highs. This is an example of why I was talking about confirmed highs. These are two very important indexes. The Composite Sentiment Index, which is at the top, and the Credit versus Equity Sentiment. And basically what happens is that when you have very negative credit sentiment versus equity sentiment, you're going to get squeezes in the market at some point. Now, it's important to qualify that because the market doesn't have to bounce immediately. But the point is that on this chart, you can see every time we have confirmed highs, which are the little arrows on this chart, like for example, here, this is a confirmed high, 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 and now we have a new confirmed high. Every time we get a confirmed high in the Composite Sentiment Index, we're going to get follow-on highs. And what I'm looking for is to see something more like this, like right in the center of my screen. That is what we need to see combining with a high in terms of sentiment. What we're seeing right now is kind of the opposite. If you look at credit sentiment has dropped further since I made this chart, which is what I was anticipating. So it's dropped a little bit further.
Because of yields going up, Peter? Is that why
it's
it
not
dropped?
about yield. No, this is emotions. This is market
credit.
emotions. So,
okay.
So the credit versus equity, it's not even sentiment of credit. We're talking about the disconnects between equity and credit in terms of emotions. And when you get a very high amount, now this is too high. This is too much pessimism here. So the market, for this pessimism to matter, we would need to be making confirmed lows. So that means that our I'm sorry about the noise here. Our market would need to be pulling back into a situation where we would be seeing a lower low relative to the same lower low emotionally. Otherwise, what's happening is that people are selling the lows, expecting the market to break down, and they're going to get predictably squeezed. So what you can see in every one of these green arrows here is that we have extreme imbalances between emotions in the credit versus equity sentiment, and we have higher lows. And each one of those results predictably in very strong squeezes. So that is what we have here. Therefore, I am thinking that we have a good chance of exceeding the 4160 target by some degree because emotions are completely imbalanced. Now, if you look at when I made this chart, right after I made this chart, we came back down and had a pretty decent test, and people, of course, getting quite bearish. But the problem is the emotion imbalances will not allow basically the people who are betting wrongly are too much on the fence to actually get control of prices. And so, you know, we're going to continue to have squeezes higher until this changes, in my opinion. Also, on this chart, we can see that basically right over here, we had extremely strong emotions. Again, this is a trend. This is not a pure emotion measurement, but it's a little bit emotional. We had some, this is a trend index that I use. It's not the standard one. And you can see, you know, very strong emotions there. So we have a very important price level, basically in the 3,800 area. This is the shelf for the market that's going to be defended. Even when we go down, that area is going to be defended in a big way if we start to, you know, move towards it. This is another reason I think the markets need to go higher. The options players are speculating in out of the money options that they are buying in expectation of trying to protect themselves. And what I have found in general is that when you have a very high amount of activity
Insurance.
in people trying to
insurance or puts.
If they're trying to buy insurance, they have to get squeezed out of their insurance first before the market turns. And I want to just give you an example. It might not look like that's what happened, but look at what happened here. Okay, what you can see is that people were buying all the insurance in before the market advanced and then had none when it advanced, and they bought all their insurance at the lows. If you look at it here, look at what they did. It doesn't look like it. Most people look at these charts incorrectly. So what happened is that people basically took all their insurance off the table before the market topped.
Right.
These
Because
out
it's
of
a
the money
waste of
options,
money. Because
yeah,
it's a
these
waste
options
of money.
need to expire worthless, and the people need to relent on them. What they're doing right now is adding to them. So this is not healthy for the idea that the market is going to turn around and go down right now. I wish it was, because I think this whole thing is an exogenous, dangerous situation. But you can see the same thing here in a different way. We have a very, very low put-call ratio. So we have now a disconnect. We have people buying tons of protection and at the same time wanting to have lots of calls. So we're setting up a very extreme environment. And I'm going to go through that in another chart, which is very important, because at the same time, people are buying an enormous amount of puts. And this is not going to work. So I think we basically have to hammer all of these open derivatives positions before the market can relent. We're just wafting between the imbalances between them right now. This is another chart that I've been watching and presenting for a long time, even though most of my work is just pure emotions. Occasionally, once every several weeks, I do a look at the markets in terms of broad charts, and then I look at charts like this, although I monitor them like once a week, twice a week, 3 times a week. This is Dow Jones Mortgages chart, and basically what we need to do is to come up and test this gap area, and I've been talking about that for quite some time. And I believe that's an area where the market will look to make a psychological decision, because, as you know, about 20% of mortgages are in some sort of form of default, and we have forbearances which will be coming due, and when they do, that's going to send that number even higher. But we have this huge optimism about how everything's just going to work out fine in mortgages.
Well, housing prices keep blowing off. There's a mad rush. People are offering cash above the listed price and competing for homes everywhere.
Yep. And this is an important chart. This is my projection of future volatility. Basically, plus or minus a few months. We're looking at low volatility right now, and that volatility should turn. I'm looking at this as fairly impending. So in other words, looking for a Q1 kind of low, Q2 low in volatility, and then a bear market. So this is projecting out to a situation in which the implications are longer term. We're talking about a 3 or 4 year bear market type of thing, if this is correct, which I believe it is. As you can see, I've been posting these and related charts for a very long time, and they have been quite accurate. This is another very important chart I've been posting for a very long time, and this is the Euro chart.
Yeah, you thought we'd go back up and retest the high, Peter?
I still think that the Euro will have to test this channel again before it kisses it goodbye, but I'm not married to that. I'm not married to that at all.
I don't think it will.
As you know, I have been cautioning about the dollar situation for quite a long time. So I am extremely bullish on the dollar, and I'm extremely bearish on the euro. So essentially what we're looking at is the euro likely to drop to around the price that it was issued. So 0.8.
I remember that.
Something like that.
Yeah. Wow. Okay.
And
so I'm thinking, Peter, let me get a word in here, that with your blow off scenario that you're painting, that I really didn't think it was going to happen. I'm actually looking for maybe the dollar to peak, or it has peaked just short term for a pullback to 92 or so in the Dixie. And that's the environment where risk can go, should give us some jet fuel to get to your upper numbers with the dollar pulling back.
I would agree with that. I would agree with that.
All right. Well, another great interview, Peter, and some interesting things. You want to
one or two more charts? Do you have time for them?
Well, quickly though, because they start another webinar in about 15 minutes. So
well, I'll make it very quick. Basically, here's a popular chart which has been being posted incorrectly of the Nasdaq. We have this huge fork that has been going on in the Nasdaq. The Nasdaq is not at the fork; it has broken out of it. So this is going to require more effort to turn it down than what people would normally imagine. And then these are the last and very important charts. This is what I'm looking for the New York Stock Exchange to basically come up and retest this resistance area and potentially overthrow it slightly. This is the options chart. The purple line on there that I was talking about is the institutional index put option buyers. They are very pessimistic, extremely pessimistic, and markets don't make highs when this is going on, in my opinion. This is the last one. This is the transports. I've been posting this one for a very long time. I believe we did that last time, and we are now in the overthrow phase, which I think should conclude relatively soon. The last situation is bonds and equities have a relationship, but it's not the relationship people think. I've seen incredible misinformation posted about this relationship between bonds and equities. This chart covers that. If people want to take a screenshot of it, they can look at it further. I believe we're looking at something like this right here because of this relationship. Okay. And then this is the last situation in terms of breadth. The highs were confirmed, although we are putting in patterns very similar to this. So I think the market is putting in the platform for very important inflection point coming up. And then this is the last one. Just the VIX is very similarly to prior to March
Yeah, we
last
filled the
year.
gap. Finally filled that gap, Peter, at
Yeah.
1820.
Yeah, and then
You
this
have a
is the
number?
last chart.
You have a number for a VIX where you think it could go to in a blow off?
I've been looking for, 18 and a half on VIX to, but I wouldn't be surprised if it wants 16 or something like that.
16. Okay.
These are the two measured target areas that I am looking at for the market. The thick one is the primary one, but the less thick one is also viable. And this is the last chart. Okay. I posted this. This is a very good chart as far as I'm concerned. Basically, we are channeling here. We need to get this momentum indication to hit the top of the channel, which I think it will. It doesn't need to do it perfectly, but I think it will. And that would result likely in something like this. So this is where, my summary is. And let's see. Just recently, this is as of yesterday, I had been posting about this line here, this big, thick end line, third end line. That is a large fractal cycle resistance level, and they are bearish. And as you recall, I was bearish right here for a pullback. We got that pullback, and I suggested that if we broke out of that line and it held as support, we would be getting an impulse higher. And I just want to share that we have held support. We also have had internal trend oscillation, which is an emotional measurement, hold 0. And therefore, it is going to take some time, if this impulse is successful, to unwind it, which means that we need this to go up until we get termination and dissipation cycles, which are called bullish retracement to end, and then usually to second end resistance cycles. So that's my overall picture here. And this was from this morning. As you can see, this played out. So these are charts I posted MCM on MCM CT markets. And
that's where you could find Peter on Twitter at MCM it's underscore, right? Or is it hyphen?
Yeah, MCM_CT is the public site where I'm complaining a lot about the situation we're in. And the markets only site is MCM CT markets.
So Peter, thank you much.
That's a members site. So if you want to join that, you have to click on the link at the on the top of the profile, and then you can register and sign up.
Okay, so that's how you both follow and join Peter in his endeavor of looking for emotional disconnects and reconnects. And I want to thank you, my trading warrior brother, for sharing your work with us today. And
thank you.
We'll do it again, buddy. And I hope that all your forecasts work out and that many participate. So good hunting, buddy.
Well, I just found a heads penny, so I think that kind of is good.
Okay, and stay in Boca for a while, and all right, no traveling for a while, buddy. All right,
yeah, no more lockdown.
I'll talk to you soon, Peter.
Catch you later.
All right, see ya. All right, that's a wrap, everyone. Hope you enjoyed Peter. Some very esoteric stuff pointing towards something that could be developing here in the next month or so. That's a wrap for us today. Don't forget to join the whole team for the Morning Edge in about 9 minutes. You're very welcome, Alex. And tomorrow is NFP. There will be a webinar. So adios, everyone. Don't just count your pips, count your blessings. This is your host, Dale Pinkert, saying later, man. See ya.